Good morning, everyone. We do apologize for the late start. We were just finalizing things for you, but thank you so much for taking the time to join us for our mid-year update. This is our 2023 halftime report with David Waddell, The Power of Reality. I'm Karen Rowe, and I am the Brand Experience Strategist here at Waddell & Associates. For those of you joining us for the first time, Waddell & Associates is a wealth management firm dedicated to enriching lives by providing clarity. David Waddell is our CEO and Chief Investment Strategist. He is great at cutting through the financial fog and using current and historical data to provide valuable insights into the global economy and how it might impact your financial world. He has been featured as an expert on CNBC, Fox Business, Forbes, The Wall Street Journal, Barron's, and Yahoo Finance. Please go ahead and use the Q&A box. David will do his best to answer as many questions as possible at the end of his presentation. If he doesn't get to yours, we will be sure to get you an answer after we sign off. So without further ado, I will hand the screen over to David Waddell.
Excellent. Thank you so much, Karen, and good morning to all of you. Thank you for clicking in. We had a couple of technical difficulties which delayed us a little bit. And so you don't see my cameraman behind the screen, but we're going to coordinate the click-throughs since the remote clicker isn't working. So be patient if we have a couple of glitches. I also want to thank Karen, who did a great job on that introduction. I want to thank Teresa Bailey and her team for doing a great job in development, getting us prepared for this. Also, Lainey, who puts up with me, which is astounding. And then Nicole, who did a fantastic job creating some amazing slides. This may be the best looking presentation we've ever done. But that'll be for you to decide depending on the content. So I titled this halftime report, The Power of Reality, and I'm going to spend some time unpacking that. But before I do, let's go back in time to 6 months ago, where I stood before you and talked about the power of perspective and ask the question, what could possibly go right? And the reason that I titled the presentation that way is because I have never seen in the history of my experience in the markets as much pessimism as there was entering 2023. In fact, if you look, economists, 45% of them that were polled going into the year said, well, we'll probably have a recession. 45% doesn't seem like a lot, but that was the most on record in terms of predicting recession entering a year. And then if you look at the consumers that were polled gave the most despondent view of consumer sentiment that they'd had going back all the way to 1977, I believe. And so economists were tremendously pessimistic. Consumers were historically pessimistic. Investors were extremely pessimistic, and these were the professional investors. So the professional investors, only 20% that were polled expected a bull run in 2023, which is a historically low level. And then when you look at retail investors, only 20% of the retail investors polled at the end of 2022 expected a bull market in 2023. That was record investor pessimism. You had to go all the way back to the first Gulf War to find investors as pessimistic as they were at the end of last year. And that led me to assert this is great news because nothing actually pleases me more than pessimism. Consider this. Historically, when only 20 to 30% of retail investors are bullish, markets are 17% higher on average a year later. When they're feeling a little bit better, 30 to 40% bullish, markets were 11% higher on average a year later. When they were feeling better than that, 40 to 50% bullish on the year to come, markets were only 7% higher. And when they were sure that markets were going to be higher over the next 12 months, 50 to 60% bullish, markets were actually lower by 2%. So my conclusion after that analysis was that, well, there were reasons to be pessimistic. We had a terrible bear market in bonds and stocks in 2022. We had this global conflict between Russia and Ukraine that suggested maybe nukes would fly. We had saber rattling between China and Taiwan. Oh, and by the way, we had the Fed declaring their policy of recession. We had inflation running at high levels. There were lots of reasons to be pessimistic, which was the primary reason I was so optimistic. So we rolled into 2023 based upon a foundation of people had just gotten way too pessimistic, and we expected to see a return in optimism in the first half. And so pessimism did peak, like I just shared with you, at the end of 2022. And since then, we've seen an absolute doubling in what I'll call optimism, or a halving in pessimism, depending on which one of those you like better. The number of bulls in the marketplace went from 20% at the end of last year to over 40% today. And as you would expect, with the rise in optimism, valuations rose as well. In fact, this is the forward PE contribution to the total returns of the S&P in the first half of the year. The PE contributed 16% of the 16.5% return for the S&P 500, which means dividends actually add a little bit to the total return. Earnings actually detracted. So it certainly wasn't the reality in the first half of the year that spurred the advance. It was the return of optimism. It was the perception in the first half of the year that returned the advance. But it wasn't just the S&P that printed a really nice return for the first half of the year. It was basically everything. So the S&P ended up the first half up 16.78%. The international markets, consider this, war-torn Europe, recessions, problems in the UK. We have 12.5% returns from those markets. The Russell 2000, which is US small cap, which is really levered to the economy, and obviously the economy hadn't been growing, and there's threat of recession. The Russell 2000's done rather well, up 8. High yield bonds, if you were concerned about some sort of economic event, if you were concerned about a banking crisis, you would see yields spike and high yield bond returns actually decline as that occurs. That was not the case. High yield bonds were up 5.4%. And then emerging markets, which are also very levered to the global economy, they face China, lots of problems there, but less problems than people expected, and they were up 5%. Even the gold bugs got in the act, with gold up 5%. Silver did not participate. Silver bugs ended up being down 5%. But overall, the commodity markets on the metal side did okay, the industrial metals. And then when you look at the aggregate bond market index, it was actually higher on the year as rates actually ticked a little bit lower. The only part of the investment menu that didn't produce positive returns in the first half were really energy, as natural gas prices came down considerably as the expectations for turmoil in the energy markets in Europe came down as they ended up having a warmer winter and they figured out how to move around Russia. And so energies ended up trading lower. Basically, everything else traded higher. And so in sum, if we go back and we consider our outlook, then as it may seem, being pessimism heavy going into 2022, the question to what could possibly go right can be answered this way. Lots of things didn't go wrong. So when you have excessive levels of pessimism, you don't need things to go right particularly. You just need things to go less wrong than expected. And that's what happened in the first half of 2023. But not everything was fantastic. So if you look inside the S&P 500 into that 16% rate of return, it didn't have very good participation overall. So you may have heard a little bit, and we're going to talk about this, the Magnificent Seven. And the Magnificent Seven consists of Microsoft, NVIDIA, Apple, Tesla, Meta, which used to be Facebook, Amazon, and Google. Those stocks as a complex rose about 70% in the first half. Now, there were two reasons for that. One, they got crushed last year. So they were coming off a low base. I think at one point Meta was down like 80%. So they were coming off a low base. Two, we got very excited about AI. And these are the largest of the technology companies, and therefore the largest producers of AI or AI hype or AI attention. And so all of that accrued to their benefit, up 70%. But when you look beyond them at the rest of the S&P 500, the other 493 companies, they were really only up 6%. And so as we enter the second half of the year, the right question to ask is, will the mega cap, Magnificent Seven, S&P kind of names end up catching down, or will the rest of the market catch up? To answer that question, I will state that I think the sentiment-driven portion of this rally is basically kind of over. To rally going forward, we really need reality to backfill sentiment. We need reality to improve. And to really understand that war and that reality, we really need to dig deep, roll up our sleeves, and go back to the fundamentals. And so the biggest contest in the market today is between the Federal Reserve and inflation. So to accurately predict where things are going to go for the market, we've got to get down to where the Fed is going to go. And so we'll spend a little time digging into that. So the good news is, here is the consumer price index going back to 2013 or so. And typically it runs around 2 to 3%, as you see, and the Fed is perfectly happy with that. Go back one. And you see this huge spike up to 9% as a consequence, really, of the shutdowns and all the COVID stimulus spending. CPI got up to 9%, but it's been on a significant glide path lower since, printing a 3% number for June, which is, obviously one of the fastest declines we've ever seen in the CPI, and should be cause for celebration, but for the fact that the Federal Reserve doesn't really focus on headline CPI. What they tend to focus on, and this has been a bit of a moving target over the past couple of years, is core personal consumption expenditures inflation, which is really kind of lagging, shows up in the GDP report. We'll get the next version of this on July 20th, which I think is Friday of next week. But nonetheless, they've got a 2% target for this, and right now it's hovering up at 4.6%. So it's come down, but not nearly to the degree that the Fed would like to see. So they are squarely still in the game. And so what the Fed has been charged with is bringing that level down, and they have two primary mechanisms, well, three. One is forward guidance, and they've been hawkish all the way through. Two is increasing interest rates, and I'll show you here a series of what they've projected interest rates will be at the end of next year. And then three is control of their balance sheet, which is the quantitative easing, quantitative tightening. Are they printing money? Are they soaking money up? And we'll walk through that. So guidance continues to be tough. It's tough talk from the Fed, although maybe softened at the margin, but they're continuing to be austere in their guidance. This is what they've been telling us for the last year and a half, where rates will go. So in March of 2021, they said rates would be 10 basis points at the end of 2023. Then they said 60. Then they said 1. Then they said 160. Then they said 2.8. Then they said 3.8. Then they said 4.6. Then they said 5.1. And then they held there for just a minute. And then at the last meeting, they said they'd be at 5.6. So they've been raising the market's expectations for the federal funds rate in 2023, which is the battleground for inflation, ever since March of 2021. And on the balance sheet side, they initiated significant balance sheet tightening about 18 months ago. And if you look at it, they're pulling $100 billion a month of cash out of the system through this quantitative tightening program. And the combination of higher interest rates to that degree and quantitative tightening to that degree has led to the deepest inverted yield curve of all time. Here's why this matters. Because banks pay deposits short-term rates, and they get paid on their loans at longer-term rates. So when yield curves are inverted, it's tough on the banks which means they're not as interested in extending credit. And usually when the yield curve inverts, something breaks, which definitely happened just a few months ago. So this is a chart that chronicles the number of bank failures by year and the total amount of bank assets associated with those failures. So just for reference, back in 2008, 25 banks failed, right? We had an inverted yield curve, we had a whole bunch of problems, but 25 banks failed, which amounted to 526 billion in total assets. Pretty destabilizing. This is inflation adjusted. This year so far, go back. This year so far, we've had 3 major banks fail. We had First Republican Bank, Silicon Valley Bank, Signature Bank, and when you total those up, the scale of those failures was the same as what we experienced in 2008. So there was a major break and a major event back in March, which caused the Fed to reverse what they were doing on their balance sheet. So they injected $400 billion back into the economy with their emergency programs, et cetera. They gave kind of an implicit guarantee of all the deposits to stem the bank run. And indeed, it was effective. And they resumed their austerity program. So there was a real quick moment of quantitative easing, and now they're back to pulling $100 billion a month out of the system. Well, this has ended up, in conversation within the boardrooms of the banks, who are saying, wait a sec, this environment feels a little sketchy. We've got this inverted yield curve. We've had some collapses. We don't want to be on CNBC in one of those sort of scenarios. And so maybe we ought to be a little bit tighter on our lending standards. And that's the case. And so they have tightened lending standards up to, call it 45%, which is the net percentage of banks tightening. And that's a level consistent with recessions in the past. They've also, therefore, stopped extending credit as quickly as they were. So go back a year or so ago, and banks were growing their credit at, call it a 10% rate year over year. Right now, that's 0.2%. So credit growth is slowing rather quickly. And that is leading to a shrinkage overall in the money supply. Like I said, the Fed's using quantitative tightening. They're using interest rate policy. They're using guidance. They're doing everything they can to push austerity onto the banks. So the banks will push austerity into the system. And we're seeing that as money supply is shrinking by about 5% year over year. That's off a considerable base, right? Because during COVID, it went up 28%. But nonetheless, it is shrinking. And this is the first time that's happened since the Great Depression, which bothers a whole bunch of market participants and leads to a whole bunch of pessimistic thought. And I'll talk to you a little bit about whether it plays through or not into the economic statistics. Nonetheless, we haven't seen shrinking in the money supply since the Great Depression. This is a pretty fascinating occurrence. But here's the question for the Fed, right? Is it enough? What the Fed knows, this is the consumer price index going all the way back to the 50s, is they've got this 2% target. We're still above it. If you really want to get to target, your best policy mechanism to do so is to invite recession, right? So each one of these shaded bars on this chart is recession. And it doesn't take long for your brain to figure out the lines decrease in those shaded occurrences. And so on average, from top to bottom, over all those recessions on that chart, inflation has fallen 7%. So if we peaked at 9 and we're trying to get to 2, then a recession is a really convenient way to get to the inflation target for the Fed. My point on this, though, is recession really necessary? So we grew GDP at 6% in 2021. That was a problem. And so the Fed got engaged. They started talking hawkish. There were a lot of things that started decreasing momentum within the economy, as well as what was going on overseas. And in fact, technically, we did have a recession early last year with a negative GDP print in Q1, followed by a negative GDP print in Q2. Now, there was a lot of interest over whether that qualified as a recession. The White House actually did some things to redefine what qualifies as a recession, and they decided that did not qualify as a recession. But when you look at this in your economic textbooks 10 years from now, it looks like a recession. So anyway, that's what happened in the first quarter and the second quarter of 2022. Then the market revived, inflation came down, that helped a little bit. But you can see we've been on this decelerating growth trend since then. And if you look at expectations for Q2 of 2023 and Q3 of 2023, that descending growth trend looks intact. And if you average this together, for the last 2 years, the US economy's only been growing at 1%. So any of you out there who are watching CNBC this morning, Sarah Eisen did a great job talking about the economy, saying some of these things are strong, some of these things are weak, some of these things are strong, some of these things are weak. Tesla's conference call last night, Elon Musk went, some places the economy's growing, some places shrinking. I don't really know what's going on. Here's the reality. At a 1% growth rate, not everything is working, right? And 1% is half of potential GDP growth for the US economy. So have we had a real recession? Maybe if you count that first and second quarter, but we've definitely had a growth recession, and that has certainly been disinflationary for the Fed. But the Fed seems fixated on the labor market. So let's just spend a moment on that. They're going to release their opinion next week on the 26th, I guess. Maybe it's the 29th that we get that core PCE. Anyway, the 26th, the Fed will release their opinion. And they will talk, I'm sure, more about the labor market. And this is why visually. So the US labor market consists of 167 million declared workers. Okay, they are in the labor market. That is our supply of labor. The demand of labor is the number of people employed plus the number of job openings. And so if you add those two numbers together, you get 171 million, which means there's an imbalance that the Fed is very aware of 4 million workers. There are 4 million more jobs available than we have workers in the labor force. And this is what is bedeviling their decision-making process as they determine whether rates are high enough. But I would argue with the Fed, if they would take my calls, that despite this, wage inflation is cooling. Now, it hasn't gotten back to their green zone, which I've stated here, at 2 to 3% in terms of year-over-year hourly average hourly earnings growth. But we're at 4% and we've declined from 6%. That's a 33% come down over the last 12 months. And by the way, if you go back to pre-COVID, we were running at the same level of unemployment where we are today. And we were right at the top end of that range of 3%. Inflation was really fine. And so it could be that if we just leave it alone, these wages will find their way lower as inflation expectations fall, and maybe the economy continues at this less than robust pace. And I would also say to the Fed, if you're targeting the labor market and you're using interest rates, that's a pretty blunt instrument, trying to manage the economy through just the balance sheet and just interest rates. And when they've tried to do this in the past in a way that's precise, they've been far off the mark. So what I'm showing you here is what the Fed has projected during recessionary periods or periods where they're hiking interest rates, that unemployment would rise. And so right now they're projecting a 0.9% increase in unemployment in 2023. And here are those other projections going back over the last 6 recessions. And here's what actually happened. And so they never tend to miss the mark on the downside. They always tend to hit the mark or miss the mark on the upside. And that upside is significant. It amounts to 2.5% of that labor force. 2.5% of a $160 million labor force is 4 million jobs. So if indeed they're targeting maybe that imbalance in labor, they've moved on from inflation because they think that is what's pernicious and durable and could cause inflation to be higher longer, they risk doing real damage to the labor market. And I'm not sure they need to do it. So why aren't we in recession, right? We've got money supply shrinking. We've got sentiment that's been low. We have all of these tools being used by the Fed to disrupt this economy. Well, I think there are 2 reasons why we're not in recession. One, we entered this period with the banks in really good physical condition. Two, we entered this period with consumers in really good physical condition. So for us to be able to avoid recession over the next few months or whatever the case may be, those two things have to continue to be the case. The banks have to be strong and the consumers have to be strong. So now let's do a little bit of a physical on each of those constituents and see whether they're strong or not. Okay, to do the bank physical, and I'm not a banker, but this is the way it worked in my brain. So bankers out there, please text me and tell me what I've done wrong. But I think this is a good way to assess the condition of the banks. So if we look at bank credit overall, remember the way banks function. They take in deposits and then they make loans or they buy securities, right? This first tranche of the $17 trillion in bank credit that I'm going to talk about is securities. So they take the deposits, they went out, they bought treasury bonds. Well, here's the bad news. Treasury bonds fell 15% overall into March of 2023. That's a huge hickey when you consider securities are 30% of total bank assets on bank balance sheets. That is what precipitated the failures of Silicon Valley Bank, First Republic Bank, and Signature Bank. And if it wasn't for the Fed stepping in, that would have cascaded into a raft likely of other bank failures. But once the Fed guaranteed all deposits, that storm passed. Nonetheless, this still gets a red slice, in my opinion, because that's where the trauma is on the bank balance sheets. The second largest component of bank assets is consumer real estate loans, right? And here's what's important to understand about this moment in time versus 2007. Right now, consumers have 70% equity in their houses. We just got, I think, new home sales data or used home sales, whatever the case may be. And the change year over year was down about 2%. I mean, you'd have to have a significant drawdown in the value of assets before it or the value of your house before it ends up being a problem for the bank. In 2008, we had these ninja loans and people were borrowing 100% and total equity was only 50%. There was a lot of leverage in consumer real estate back in 2008 that's just not there today. And let's also recall that at an unemployment rate of 3.6%, the consumers are employed, they've got income, they can make their mortgage payments, even if some of them are higher. Because remember, you locked in 30-year mortgages at very low rates. You don't have to refinance for a while. So just because mortgage rates have gone up doesn't mean that people that carrying mortgages are paying those rates. That's only happening on new transactions. All right, the next largest category of bank credit is business loans, loans to people that make things and do things. That's 16% of overall bank credit, which is 17 trillion. What's going on in that segment? Well, we are seeing higher lending standards, right? As we showed earlier in that slide, there is less credit extension there. So it's a little harder to get credit if you're a business from traditional lenders, but we're not seeing high delinquencies. We're seeing some uptick in bankruptcies, et cetera, but systematically delinquencies across commercial and industrial loans for business use are still pretty low. So that gets a green light in the chart for now. If we go into recession, maybe that changes, but for now it's green. All right, commercial real estate, I'll spend a moment on this. Commercial real estate is 13% of total bank credit. The properties that are really impaired right now are the office properties, specifically urban office, and also inner city retail, right? Because they thrive off of full offices. Multifamily, industrial, and retail at large overall are performing rather well. So it's really just that segment, office and inner city retail. And when you look at commercial real estate overall, therefore, delinquencies are pretty low and loan volumes actually remain high. I believe that over the next 18 months or so, maybe 2 years, there'll be about $500 billion worth of office, commercial real estate stuff that rolls, that needs to be, restructured. That 500 billion amounts to if all of that defaulted, if that entire 500 billion didn't, renegotiate terms and all of it defaulted, that would be the size of what we went through back in March. And that's a rolling 2-year period. So even if there's significant trauma there, I just don't think at this point it's large enough to take down the system. Now it's hard to get information out of banks because they don't tell you things are bad, because if they do, there's a run on banks. And so you're always getting, everything's awesome when you hear the commentary from the bank. But when you dig into the details, I just don't see the trauma here. It's not great, specifically if you own office property in downtown San Francisco, but I don't think it's systematic the way the retail housing sector was in the crisis in 2008. So I'm going to give that a yellow and open for debate. The next tranche is consumer loans. Well, not only are consumers more creditworthy in their housing activities, they're also just more creditworthy overall. In fact, consumer debt to GDP was at 100% in 2008. It's down to 75% today. Consumers really did cut up their credit card, repaired their balance sheet, debt service levels. I'll spend a little bit more time on this when we talk about the consumers. Even though interest rates are going up, are 30% lower than they were because those debt piles are so much lower. And let's not forget, real disposable income is growing. People are employed. And so overall, the creditworthiness of the consumer is good. I give it a green. And then there's this other slice that's 12%, which is wholesale lending activities and some other things. I'm not going to dig into those, but there's nothing systematic or cause of concern there. So overall, I think the banking system's in pretty good shape. They also just went through a stress test where the Fed tested the 22 largest banks. They all passed. There was some backfilling on reserves that needed to be done, but basically they all passed under pretty draconian stress and scenarios. Fortunately, you don't have to do all that work I just did. You can just Google this. The St. Louis Fed Financial Stress Index will give you a read on how much stress there is in the financial marketplace, which would, of course, land on the bank's doorstep. Go back to 2008, we were seeing higher levels of stress, and then the earthquake hit, and you can see the stress index went through the roof during the global financial crisis, and then the Fed had to step in and save us, which they always do. And then you go forward to COVID. Obviously, there was a spike higher there because the economies were shut down before the Fed stepped in and saved us once again. And then if you look at the right side of your chart, we had a little bit of a spike when Silicon Valley Bank went down, but it wasn't anything to the degree of COVID. It wasn't anything to the global financial crisis. Fed stepped in, fixed that as well. And so right now, the financial stress index is at near the lowest levels on record. So there's not really any financial stress in the market today. The banks are in a really good position. All right, so that's the banks. What about the health of the consumer? That's the second big leg of support underneath this economy. So before we look at the consumer directly, let's go back and do a little economics 101 and recall that structurally consumption is 68% of US GDP. You may remember the maxim, as goes the consumer, so goes the economy. This is why 70% of our economy is consumption, 17%, as you can see, is government spending, 13% is investment ex housing, that's business investment activity. And then you got housing at 4% and our trade deficit at negative 3.2. So the US economy runs on the US consumer. So let's start with their income statements. Right now, the US consumer is growing real disposable personal income that they can spend on stuff to the tune of 4% year over year. Now, this is a fascinating chart. 4% is fairly normal if you go back to pre-COVID. Then you see the surge higher because of all that mailbox money and stimulus spending. Then you see the surge lower when inflation crushed real incomes. Well, now inflation's come down, wages have come up, things have kind of normalized for consumers, and that's what's helping grow their income statements 4% year over year in real terms. What about the net worth side of the equation? It's kind of fascinating. I remember 2008, and we have 1,000 clients or so, and there was a lot of heartburn in 2008. We just didn't experience that kind of heartburn last year across the client base, and here's why. Yes, markets went down. We insulated some of that, but markets went down. Housing prices, on the other hand, went up. And so from a net worth perspective, the drawdown year over year was really only 3%. Contrast that with what happened in 2008, when bonds went up a little bit, which was helpful, but houses went down, stocks went down, overall household net worth went down 13% year over year. That's a really big hickey. 3%, I mean, it's not great, but it's certainly not traumatic, and it's something we can live through. So when you look at household balance sheets, they're really intact. Net worth is intact, and in fact, it's rising again. And we talked a little bit about credit worthiness, but here is the chart that shows you household debt service payments as a percentage of disposable income, right? Because it's the flow that matters, the cost of servicing debt, more than how much debt do you actually have. It's the cost of servicing it, and what percentage of your income does that take? And it takes 9.5% of your income today to service your debt service, against 13% because we were running hot on mortgages, we were running hot on credit card debt, HELOCs, all sorts of things. So consumer balance sheets are in really good shape. In fact, even at these levels of higher interest rates, that 9.5% is less than we had going all the way back to the start of this chart in the early 80s. So there's plenty of scope for consumer credit at the levels that we currently sit. And also, there are still some spending reserves intact. So these are the excess savings generated by all that government fiscal spending during the COVID period. We topped out at $2 trillion in excess spending as consumers. Now we're down to about, 100 billion or so. So that number is going away. We might see credit card usage come up. Student loan payments are coming back, and that may chip away at this as well. But as we saw, there's plenty of scope for credit enhancement. And on the reserve side, there's still some gas left in the tank, just not quite as much. So overall, the consumer is in very good shape. Banks are in very good shape, but that's not necessarily great for the Fed, because what the Fed wants is lower inflation, and yet we're seeing some economic strength. And so how much do they really have to do? How much further will they really have to go to reach their objective? So let's dig into that a little bit. As I just mentioned, the economy actually is surprising to the upside, which is obviously benefiting investors as this market has been melting up over the last 10 days or so. This is the economic surprise index, and it basically says when the economic reports come out, were they at expectations, below expectations, or above expectations? If they come in above expectations, that's a positive surprise, and you get this green line. Number came out yesterday. I think it was the highest we'd had going back to 2021. So the economy is surprising to the upside right now, which is a consequence of low expectations and also just better overall performance. That's good for us, not necessarily good for the Fed. However, the following slide, this is the Citigroup Inflation Surprise Index, which looks at the inflation reports. And if it's above, then you get a red mark. If it's below expectations, you get a green mark. And right now, inflation is coming in below expectations. The CPI reports have been coming in below. Core came in a little bit below. The PPI reports come in below. Inflation overseas has been coming in below. UK came in below. China came in below. We're waiting on some European statistics. They'll likely come in below. Australia came in below. So the whole globe is sort of disinflating right now. That is good news if you're the Fed. And right now, the Fed has taken the overnight interest rate up to the highest level since 2007. So we sit at 5 to 5.25. They've signaled they might like to go a little bit further, but that takes us back to where we were in 2006, where we sat until late 2007. This is the highest level since then. If we go above that, one or two more hikes, you're way back into the dot-com era of 2000. So interest rates have gotten pretty high, pretty fast, and it takes a while for that to filter through the economy. The market sees inflation whipped, right? The market is saying, Fed, you've done enough. You got this quantitative tightening thing happening. You browbeat us with your guidance. You've got interest rates up to 2007 levels. We're seeing inflation surprise to the downside. We don't have expectations of runaway inflation. In fact, if we look at the 5-year forward break-even inflation rate, we think inflation will be 2.1%, which is right at your target. So according to the market, inflation is whipped. But the Fed seems to want to raise more. I was thinking about this, and it may sound grotesque, but there's always this moment at the end of the horror movie where they've killed the guy, but you're like, just put one more bullet in him just to be sure, or cut his head off or something like that. I think that's kind of the moment that the Fed's in. I think they've kind of killed Jason, but just one more maybe to finish him off, just to be sure. So they've talked about raising rates from where they are now they call it 5.1 on average to 5.6. So they've signaled to the marketplace maybe 2 more hikes. But then when we go into next year, they're talking about 4 cuts. And when we go into the next year, they're talking about 4 more cuts. So we're talking about hiking just a little bit more and then cutting rates all the way down 2% from where we are today over the next 2 years, which seems to me like, guys, we're at the end game here. Okay, so as investors, and it's important to understand this, we don't invest in politicians. We don't invest in governments. We don't invest in the economy. We do, but it's indirect. We invest in companies. We are investing in company earnings. So as we dig through the power of reality, we really need to do an earnings check, figure out where we are and figure out where it's going. If what we need going forward is for the fundamentals to lift this market, then we've got to have earnings lift from here. And so here's where we are. Certainly not much recession forecast in the earnings. I'll recall at the end of 2022, the economists and strategists that were calling for recession were also calling for earnings to be down 25%, which is where they are on average. Of course, averages are always misleading because you've got data in there that's anomalous, and some of that was like depressionary data. So that didn't make any sense. Median might have made sense. That was down 13%. Okay, so we sort of accepted that a little bit, but then down 13% didn't seem that bad. Well, guess what? The top to bottom decline in earnings may be happening right now, and the analyst forecast is for 7%. That's really a non-event, right? And in fact, earnings have been surprising to the upside. Now, looking forward, if this is the trough moment for earnings, looking forward, earnings should recapture all-time highs by the end of the year, maybe into next year. So certainly not much recession forecast in the analyst expectations for earnings. In fact, earnings estimates as of late have been rising. They bottomed right when SVB failed in March of 2023. And since then, they've actually been churning a little bit higher. So earnings estimates aren't falling right now. Earnings estimates are rising. And markets also look ahead, right? So what I'm showing you on this chart is where we are today, which is 2023. Analysts are predicting, this moves around a little bit, but basically the earnings will be flat year over year with calendar year 2022. Then we see a dogleg higher in calendar year 2024 and higher still in 2025. And so the markets see this and say, hey, that's a 25% gain in earnings that we need to start putting probability around. Now, when I first reviewed this, I thought, well, that seems like a lot. But just for orientation here, between 2016 and 2019, Trump tax cuts certainly helped in there, but earnings went up 37%. So there's certainly precedent for it. So the market's looking forward at calendar year 2025, and they really like what they see. So now we're going to do a little math. I went back and I looked at the estimated earnings for each year. And I said, okay, if the markets are going to look 1 year forward, then I need to take those forward earnings and multiply them by what seems like a reasonable PE. So I went back and looked at the average PE over the past 10 years or so, and it's about 18. So we're going to take the forward year earnings, we're going to multiply it by 18 to get an estimate for where the market should close the year. And so this is forward earnings times a PE of 18 for each year, going back to 2013. And so those were the estimated close levels for the S&P. 2013 estimated close was 2,000, 2022 estimated close 4,000. Here were the actual closes. And so you can see there's not that much discrepancy around the numbers. There are some anomalies. right? Principally what happened in 2021. So the estimate for the year-end close was right around 4,000. The market actually closed well ahead of itself at 4,766. Well, there was comeuppance in 2022, reasons to be concerned. And so some of that helium came out of the market. We closed last year at 38.40, a little below 18 times forward earnings. For the first half of 2023, we closed at 44, or excuse me, year-end estimate for 2023 is 44.50. We closed the first half at 43.28, so not too far from the estimate. We're a little bit above that today, 4,500 or so. So maybe we're borrowing a little bit in next year's return into this year, but that's okay because those forward-looking earnings are so robust. The estimate for the close next year is 49.50. We're at 4,500 today, call that 5,000. And so maybe there's 11% more in the tank. And so if we take some of that away from next year, that's okay. But to me, if those earnings estimates are intact, then this market rally is not over. All right, so that begs us to answer the question, will the market end up catching up overall to what the Magnificent Seven have achieved with all that AI hype, or will the Magnificent Seven end up descending lower? Because the market is becoming more fundamental focused, less sentiment focused. Let's dig into that question a little bit. So indeed, the Magnificent Seven for the first half of 2023 were magnificent. So NVIDIA stock went up 190%, Facebook 139, Tesla 116, Amazon 55, even stalwarts like Microsoft up 49, Apple 42, Google 36. So the Magnificent Seven was certainly magnificent. The AI hype was great. The big houses on Wall Street did everything they could to promote them. And remember, these stocks were coming off oversold levels at the end of 2022. But all of that hype and all of that excess return has pushed these stocks up pretty high. So right now, those 7 stocks alone account for 30% of the entire S&P 500. So want to know what the S&P 500 is doing? Check in with the Magnificent Seven. And that 30% threshold is where they got to during the COVID highs of 2021, after falling all the way down to 20% as a percentage of market cap. Obviously dramatic underperformance. So they're really kind of right back where they were. But poking above this puts them at significant weights, all-time highs, historically unprecedented for single companies within the S&P 500. And so because they're such a large weight of the S&P, and because they went up 70% or whatever it was on average over last year, they really propelled the S&P 500 up to 16%. If we just equal weight all of the 500 companies, meaning we only allocate 20 cents of every $100 to each company within the S&P 500, and we mitigate their scale, the S&P 500 was really only up 6%. So is the 16% coming down, or is the 6% going up? That's the right question. Well, let's dig into the fundamentals, right? Going back to the task of checking reality. So here are the valuations, right? The Magnificent Seven right now trade for 31 times forward earnings. That's a lot. The S&P 500 right now trades for 18.7 times forward earnings. That's kind of a lot. And especially if you go back to my logic that the S&P should trade around 18 times. So it's ahead of itself. However, once you get outside of the Magnificent Seven and outside the S&P 500, things actually get pretty cheap. So international stocks overall are trading at 13 times, mid-cap US 12 times, small cap US 12 times, emerging markets even less. That number's flawed. I think it's more like 11 times. So the rest of the market is decidedly cheap, even though the Magnificent Seven is decidedly expensive and skewing the valuation of the S&P 500. Relative to themselves, if you look at these individual categories, not only are they cheap relative to the S&P 500 and Magnificent Seven, they're actually cheap relative to themselves. So if you go across the last 25 years, developed market equities outside the US are basically trading at their 25-year average, but emerging market equities cheaper than it's been over the last 25 years. US small caps cheaper. US value is a whole lot cheaper than it's been over the last 25 years. So I listen to a lot of the commentary where people say this market's overvalued, this market is overvalued. They're right, but which market are they talking about? If they're talking about the Magnificent Seven, if they're talking about the S&P, maybe. If they're talking about everything else, that stuff's still cheap. And so my thesis for the second half of the year is that the rest will catch up. So going back to that PE ratio analysis, let's see if it's been instructive for what's happened so far in returns for the second half of 2023. So the Magnificent Seven continue to garner love and attention. So far in July, and this was as of 2 days ago, they're up 4.8%. Now, right before I started this, the NASDAQ was down, I think, about 1.5%, or at least the Qs. So earnings season could reveal as reality hits. I think Netflix underperformed, I think Tesla underperformed, and then we'll get a whole lot more tech earnings in a couple of weeks. But reality could deflate some of what's gone on with the Magnificent Seven. Nonetheless, as of 2 days ago, up nearly 5%. But then your leadership is small caps, mid caps, emerging markets, international markets, and then the caboose on the train is the S&P 500. So at least 2 weeks does not a half year make, but at least for the first couple of weeks, it does demonstrate that others are thinking the same way, that capital is flowing this direction, and that the second half can really be about the rest catching up. Now, since we're on a bullish note, I will provide you some other tidbits that keep you warm at night. If you look at second half stock market performance, following very strong first halves, they tend to be strong as well. So on the bottom of this chart, I'm showing you categorically first half S&P returns of 0 to 5%, 5 to 10, 10 to 15, 15 plus. The light purple on your right-hand side is the world we lived in the first half. And then if you go vertically, the second half average returns for each one of those cohorts ends up being as listed. So if we were up 5% the first year, half of the year, we might expect maybe 3.5 for the second half. We were up 5 to 10, maybe 5%. The world we're living in, maybe 11%, maybe 6%, well above average. So first half returns, if strong, tend to presage second half returns being strong as well. And disinflation, I should say, is absolutely the best investment environment. I've said it a couple times, and I'll say it a couple more times. Returns during disinflationary environment are 3 times more than returns during inflationary environment. So this goes back and chronicles periods of time where we've had the CPI fall 5% or more year over year, and there have been 1, 2, 3, 4, 5, 6 occurrences of that. And here's what happened to the S&P over the next 3 months, 6 months, 1 year, just so I won't make you read all that. Here are the averages. So average would be after inflation falls to that degree, 3% gain on the month or the 3-month period, 8% over 6 months, more importantly, 18% over the next year. And so that analysis was as of the end of May. That downtrend continued into June. Disinflation is really good for equity market returns. And if you're in a disinflationary environment, you're probably getting relief from the Fed as well. So this chart shows you the return of various stock and bond market indices after the Fed has completed its rate hiking cycle. And as you can see, 12-month forward for US stocks up 24%, a little bit better for value. Small cap did well as well. And then if you look at the bond side, everything works because interest rates overall head lower, and everything on the equity side and everything on the fixed income side outperforms money markets. So that's very bullish as well. And the other thing to remember is that markets are really all about money flows. If people are taking money out of the marketplace, values go down. If they're putting money into the marketplace, values go up. And so people have been taking money out of the marketplace, putting it into money market mutual funds, which means right now we actually have a record level in money market mutual funds at 5.5 trillion, earning, call it 4.5% to 5% on average. If the Fed cuts rates to 3.5% over the next 2 years, then these money market rates are headed down to 3.5%. That's a whole lot of cash on the sidelines that's going to have to contend with declining rates in money market funds while watching rising returns in the stock market. That tends to be pretty winsome. That money comes in, rally continues. So there's plenty of rally fuel in the tank. All right, with that, I'll stick the landing. Here is my bottom line for the halftime report. The first half of 2023, optimism returned, just like we said it would. The AI hype that powered the Magnificent Seven also ended up powering index returns. So at the margin, we had optimism rising, and then we had excessive optimism fueled by this whole concept of AI. The rest of the market performed, but it lagged, lacking fundamental conviction. All right, so for the second half of 2023, the fundamental case will return. This economy has a lot of resolve. Banks are in good shape. Consumers are in good shape. The Fed's doing everything they can, but they're really not at war with the economy. They're really at war with inflation, and they're winning that war. And the marketplace doesn't see any inflation going forward. So we think maybe they raise one more time and then they stop, or at least pause. They won't say stop, they'll say pause. And they'll probably suggest that there are more rate hikes in the future. But next month's CPI report is going to be even less. This disinflationary case has taken hold. Wages are coming down. So I think the fundamental case will return because I think inflation will fall, interest rates will peak, and economics and earnings forecasts, a little bit of a stretch, I get excited, will actually rise, I think, as we go forward. Earnings estimates have been rising. I imagine economic forecasts could start rising as well. And so the sentiment rally that we had in the first half of the year, I believe will mature into a fundamental rally in the second half of the year. And that helps us answer our operative question. I believe when it comes to will the big catch down or the small catch up, I think the rest catch up. And that doesn't necessarily mean the big catch down. I think they can move together. I just think you'll get outperformance from those that'll benefit from the fundamental recovery that should take hold in the second half of the year. So in the power of reality, second half 2023, I think the rest catch up. And that is my formal presentation. Happy to entertain any questions if they've rolled in.
Absolutely. We did get a few questions. Well done, David, first of all. It takes a while. All right, the first one is, what are the biggest risks to your forecast?
In the short term, sentiment has gotten pretty bullish. Now, sentiment on the bullish side isn't as useful an indicator as sentiment on the pessimistic side. When pessimism gets really high, that's bankable. When optimism gets really high, it can take a while for that to deflate. But sentiment's gotten pretty high. So if you look at, for instance, what happened today with Tesla and Netflix and some of the other stocks who had earnings, they just weren't quite as good as expected. We sort of had peak expectations for a lot of those things. That can lead to a sell-off. And so I think technically we may be overbought here. We may be due sort of a summer swoon. But I think that brings cash in because there's plenty of cash out there. So I'm not expecting a big drawdown. The biggest risk to my forecast is that the work that the central banks have done, and I'm not just talking about the US central bank, I'm talking about the British central bank, the European central bank, the Australian central bank, emerging markets, the work that they've done has been overdone. So we're seeing softness in China. China matters. China ends up selling into, or Europe ends up buying from China. China sells to Europe more than they do with us. And so some of that's spread into Europe. So the Europe economic surprise index is actually negative right now. So there could be an importation of slower GDP growth into the United States of America if the Chinese don't stimulate to a large degree. Historically, they've done that. They've been a little resistant to do that this time. So I do think we could catch a little bit of recession's too strong a word, but slow growth flu from the rest of the world. And if the Fed is busy raising rates in trying to rebalance the labor market, if that becomes their objective, and we're importing recessionary impulses from overseas, then that could cascade in the United States of America, and 2024 could end up disappointing. So that's certainly not the base case, but that is something that I'm concerned about right now. Otherwise, I don't see a huge raft of systematic defaults, but I guess that's possible. We don't invest in possibilities, so maybe Putin tosses a nuke, but that's not really investable. Certainly hope that doesn't happen. So there are some things that could destabilize. And in this business, there's no such thing as certainty. If you have conviction, that means you believe something 51%. So I have more conviction about my call than that, but I'm also always thinking about what could go wrong. And those are some of the things that could.
Okay. And so given that, so what is your view on the US dollar?
So the dollar peaked at 114 in 2022 in September, and that was a moment of great stress. Since then, the dollar's gone from 114 to about 100 where it is today. So if the Fed goes into an easing cycle, that's dollar bearish. And so I think the dollar, the dollar is where you go and if anywhere on the planet when you become pessimistic. So there was sort of a pessimistic high in the dollar at 114. I think we're in a little bit of a downstroke here in the dollar that could persist for a while. That is very good for my thesis because earnings should get a significant contribution from the decline in the US dollar. And the decline in the US dollar also means you have foreign currencies that appreciate. So if you own stocks in foreign currencies, you get a currency tailwind there as well. So I think the dollar can drift lower as the Fed eases its stance, and that will be good for US earnings, and that'll be good for investor earnings of companies abroad.
Okay, and we have one more question. It's just about the election cycle. How will that impact your call?
Yeah, so there's going to be a lot of chatter about the election. I guess it happens next year, unfortunately. The best returns you get in the 4-year cycle are in the 3rd year of a presidential term. Guess what? That's where we are. So on average, those are 10% plus kind of average return years. Markets are smart, by the way. If you're just a student of history, the algorithms are basically repeating themselves. The second best return year is during the election year. So if you think about it, if Biden is trying to get reelected, then what Biden wants is a really good economy, a nice stock market, et cetera. So you got a lot of incentive from at least the White House to prop up the economy, prop up the markets. And so the 4th year of the presidential term ends up having the second highest rates of return, up around 8% plus. So we're kind of in the sweet spot of the return cycle, despite what will be, a whole lot of bellicose rhetoric coming from both sides of the aisle. So I don't concern myself too much with those events. If they're big policy proclamations, then we need to bake those in. Again, going back to that surge in earnings when Trump got elected and cut taxes, whether you're for it or against it, doesn't matter. It was good for corporate earnings and benefited investors. So policy matters, but that doesn't really end up striking until the bills are close to passage or pass. So I'm not too worried about what will be a whole lot of media consternation. Historically, the 3rd and the 4th year of a presidential cycle are the strongest for investor returns.
All right. Well, I think that's it. We had another question on the political environment. So hopefully that was answered. So thank you, David. And thank you to all of you for tuning in today. If you have any other questions, please get in touch with your W&A wealth strategist, or you can email David directly at dwaddell@wealthstrategists.com. We will be sending out the video replay in the next few days. It will also be available on our website at wealthstrategists.com. Also, please sign up for our weekly email. If you haven't already, just head over to our website and sign up on the homepage. And don't forget to follow us on social media. I think I covered everything, and that's it. So thank you again for joining us. Have a great week, and we'll see you next time.
Thanks, everyone.